Good evening and welcome to the May 20th and also the Memorial Day or Memorial Day weekend edition of Bond Squad After Hours. That's why we have BDUs on. Dug these out of the closet. This was actually a reserve pair I had from my days serving in the National Guard. Never even had the name tape put on them yet. But I kind of use for my quote-unquote recreational activities. As always, Bond Squad After Hours is presented by Wealth Strategies and Management / Bond Squad. WS&M LLC and Bond Squad are separate entities from Private Advisor Group. Private Advisor Group is a registered investment advisor, and through which we publish our reports and manage portfolios on an SMA basis. So with that being said, let's kick off this evening with a discussion of the yield curve and the Fed. There seems to be a misunderstanding of really what makes the bond market tick. And in not so CIO Jeff Gundlach kind of ripped the media, a particular financial news channel in particular, nicely or not so nicely, or well, basically he said they didn't know what they're talking about. With the long end curve, rates on the long end of the curve moving higher, this news channel was of the opinion that the bond market was trying to tell the world that it thinks the Fed is going to tighten sooner rather than later. Mr. Gundlach, much like we here at Bond Squad, took it as a somewhat opposite story. When the Fed tightens, the yield curve tends to flatten. And the other day in Making Sense, we published historical charts. Everybody loves historical charts in these modern portfolio theories, technical analysis days. So we obliged with some historical data. And the historical data tells us that every single time, and we do mean every single time, at least in the past 25 years, that the Fed has tightened, the yield curve has started to flatten. It didn't go immediately flat, but the curve started to flatten. The shape started going like this. All right. Well, we explained this before with our little hand motions that usually before the Fed tightens, we have inflation running up and the curve steepens most of the time, but not all. As we saw in the late 70s, most of the time, higher inflation corresponds with higher growth. Then the Fed plays catch up. All rates move for a while till the Fed arrests inflation. The curve flattens, inverts. The Fed has to ease to re-stimulate the economy as it dips close to or into recession, or repeat the whole again, right? For some reason, the media doesn't understand this. They don't understand that the various spots of the yield curve respond differently to inflation, to Fed policy, and to how Fed policy affects inflation. So we want to make it clear what our opinion is at Bond Squad. When the Fed eventually tightens, or at least announces that tightening is near, we expect the yield curve to flatten. It may not go flat. It still may be positively sloped. But rather than being 2s to 10s being about 175 basis points, it could be 100 basis points, 50 basis points, then 25. Eventually be flattened. It'll be flat. What we don't know, but we have our own opinion, is where rates will be when it goes flat. Now, we were discussing this today with a former colleague of ours who now works for a large Wall Street firm that is known in many circles, especially bond circles, as arguably the best managers of risk on the street. And we were discussing this, and we differ a little bit on the absolute rate that the curve goes flat, but we were in agreement that the curve probably goes flat at a relatively low interest rate. Bond Squad believes that it's possible that at least from 2s to 10s, we're above 3%. We might not even be above 3%, Fed funds to the long bond. Doesn't mean they can't get above that in the interim, but when it goes flat, it'll be relatively low, rather than relatively high. And we do not think the 10-year is a lock to go above 3%, not only this year, but next year, the year after that, or any time during the next tightening cycle. The online journal this evening, had a little quick article asking, are lower rates the new normal, and has financial crisis changed the economy? It's not the financial crisis that changed the economy. It's the changing economy that caused the financial crisis. We reports, if you look in the late 80s, population growth really started to tail off. I mean, fairly dramatically, at least noticeably, right? So you had fewer. You set the stage for having a slower pace of new consumers entering the economy. So what do you have to do? And also new demand, first child demand, whatever, when the boomers were kids or when they were having kids, the echo boom, the childbirth trends, did bigger homes, more spending, the family cars, the whole 9 yards, right? What happened though is that you didn't have this organic growth to support the kind of increase to GDP that you'd like to see if you were the Fed. So what happens? You lower rates. If the pace of consumers entering the economy slows, then to maintain growth, you have to expand the ability of existing consumers to consume. And that's what happened. And that's why if you look at a chart of the 10-year Treasury note yield for the last 25 years, it goes like this. All right, and we have it on. We've had that chart in our reports before, and we'll gladly to provide that for anybody again. The numbers don't lie. So you had a situation then where the Fed would keep lowering rates to spur demand. But now, when you consider a 0% Fed funds rate, when you consider a Fed balance sheet via QE, when you consider various other programs the Fed's involved in, other open market activities, we are now at what I like to call recently a 0 degrees economic Kelvin, absolute zero monetary policy as far as accommodation goes. You are about as accommodative as you can reasonably get. You are at pretty much the absence of all monetary hindrance. 0 to Kelvin, absent degrees Kelvin for you non-physicists out there is the absence of all heat. Absolute zero, cannot be colder. All right, that's if we're not absolute Kelvin monetary policy wise, we're probably pretty darn close. Okay, despite what the Fed said. So, that was necessary, at least at that point, at least in the Fed's mind, to generate growth. However, something has changed in the economy. The very same people who drove consumption came of age in the 60s, from the 60s to the 70s, as they had kids in the 70s and the 80s, are now the primary instead of consuming via leverage, mortgages, credit cards, home equity loans, they now need to consume via income. So the very people that you helped with low rates from a borrowing standpoint from 1964, when the first boomers turned 18, let's say, to the financial crisis, you're now hurting because they need income with which to spend. And this is what's keeping the demand for bonds tremendous. And once we had that uncrowding of the trade in European sovereigns, what happened? The 10-year is kind of stuck, mainly in the 220s. There was nothing out there to push it higher. So we will argue that it shouldn't have been below 2, and that was the result of a crowded speculation in foreign sovereigns. So this might be what's more normal environment. The Fed raising the Fed funds rate is not a guarantee, except for maybe a knee-jerk reaction for long-term rates to move higher. In fact, it's a reason for long to put or go up and start to come back down again. The nonsense in the financial media, especially on television, is unreal. The argument there is, what's better, stocks or bonds? I don't know. Tell me, what's better, a Dodge Caravan or a Ferrari Enzo? Well, most of us would probably rather have the Ferrari Enzo. It's kind of quick, handles turns nice, gets a lot of attention. Try hauling 3 kids, groceries, and the family dog in an Enzo. Not happening. It's a different tool for a different purpose. So the argument of stocks or bonds, which are better, is stupid. It's absolutely stupid. And investors and even some advisors buy this. Oh, gee, yeah, we got to get out of bonds. Yeah? Well, what's happened as rates popped? Look at the Lipper capital flows, fund flows for those of you, who play the mutual fund world. Every time rates go up, it draws in capital into fixed income. The guys on TV keep telling you, oh, it's repellent. They don't see their prices go down. Price performance is not the goal. Income is the goal. And when the ability to generate income rises, capital flows into bonds. The one exception has been municipal bonds. There's fear out there, mainly because of Puerto Rico, California, New Jersey, Chicago, that there are time bombs in municipal bonds. We disagree. Yeah, there are trouble spots. We probably wouldn't want to own any pension bonds from those troubled areas, but essential service revenue bonds or any state GO, heck yeah, we do that. You have A-rated municipals 10 years and out that are trading just under the yield of an A-rated corporate. That's pre-tax, okay? After tax, it blows away corporates. And you know what? An A-rated muni have a chance of default on a historical basis than A-rated corporate, okay? But the knuckleheads out there will keep telling you, oh, be afraid of this. It's sensationalism, okay? They don't, and when the story goes against them, they have to try to spin the story. Case in point, we had a story today that the Bureau of Economic Analysis, BEA, acknowledged that there might be formula, and that maybe Q1, not only this year but in previous years, may have been understated. But the BEA also said that the seasonality problem that caused Q1 GDP to be did not cause the annual GDP to be understated. In other words, you might have had an understatement in Q1, but the rebounds you saw in Q2 or Q3 might have been overstated. So there was a smoothing problem. Is the seasonality put some activity in one month or one quarter, and it should have been in another month or another quarter? It didn't misrepresent the data, it just put it in the wrong bucket, if you will. So the BEA warned that this does not mean that annual GDP was incorrect. What did the television media do? Oh, look, economy's better. Q1 might not have contracted. All right. Well, if the seasonality was right, maybe we weren't at a negative 2+% in Q1 of 14, but maybe the rebound in Q2 and Q3, instead of being 4, 6, and 5% GDP respectively, maybe they're 100 or 150 basis points lower, right? And you still get the same 2.4 annual for 2014. Now, this presents a problem for 2015, being we are running right around 1% for Q2. So let's say the BEA is right, and Q1, instead of contracting around 1%, which is what the street thinks the number will come in based on current methodology, a positive 1.4, and I think that's what the San Francisco Fed is thinking, using a more updated methodology that the BEA is considering, right around 1.4. Okay, fine. So you didn't contract, you grew a robust 1.4, but the current Q2 is tracking at, well, that means the seasonality formula here has to be pulled back. So maybe you're negative 0.4 in this month, and net, you're the same as it was. You're going to be basically flat first half. All right, that looks to be the truth in this. But does the media report it that way? Nope. most pundits out there just reported the fact that Q1 was really better than what the number said. It has to be revised higher. Story. We believe the economy has changed. It cannot grow as quickly as it did before because the population and therefore the number of consumers is not growing as quickly as it did before. It's very difficult to get consumers to spend more per person because you're already at absolute zero, basically, on policy. And you could see this in the MBA mortgage applications data. MBA mortgage applications, Mortgage Bankers Association, has fallen each of the last 4 weeks and 5 of the last 6. So as mortgage rates in the 10-year have risen, applications have fallen, both for home purchases and for refinancing. Right now, we're seeing the fixed rate mortgage average just over 4%. That is too high for some people. Remember, it's not the absolute rate, like, again, the pundits say, 4% still low, 5% would still be low. Yes, for those of us who lived through the 80s, dirt cheap. But interest rates stop becoming stimulative when they become expected, commonplace. So now 3 and 4% mortgages are not unusually low, they're common. So 4, 4.5, 5 become expert. When you refinance, you have to save. It used to be 3 points. Maybe somebody wants to save 2 points. On a refi. How are you doing that if you took a mortgage out between 3 and 4%? How are you refining? The fat coupon mortgages, most of the ones that, for various reasons, credit reasons, or maybe just because people have a very small balance on them and don't want to take cash out, they're not going to refi it. All right, so that refi activity's out. Well, that means the piggy bank of the house. Like, I'm sitting here at the Bon Squan Lodge. Piggy bank is closed. Now we have a little bit of money in this little piggy bank in the country. You can see the woods behind me in the window. That's actually a real forest. Not a backdrop. The piggy bank is gone. As far as the ability to tap equity. Are you going to refi it at 4.5 or 5? Taking money out? Maybe not. It's not so clear cut, right? When you had an 8% mortgage and mortgage rates went down to 6. Slam dunk, take the piggy bank, crack it open, and my monthly payment stays the same. It's a different environment. We keep waiting for the old normal to happen, and it's not happening. And you're seeing that with the oil market and gasoline prices. Consumers are saving it and they're spending it on services, and that's what you see if you listen to the executives from Kohl's, from Lowe's. Then the oil patch one for Kohl's rather. Kohl's reported that the sales they lost in the oil patch regions outweighed the gains they got in the rest of the country. All right. Lowe's executives pondered, maybe it's consumers are spending more on services than on goods. And we see that in our lives. We spend more services here in the Bon Squad Lodge. Our children do. Our friends do. They're more likely to spend on cell phone service, streaming a movie, various conveniences, food delivery, stuff like that. Conveniences. It's not only a service-based economy, it's a service consumption economy. The people are consuming services rather than goods. Look at the oil sector. Some funny things happen with oil, right? What's happened with oil is that the amount of rigs has declined, but oil production has increased, even as the number of oil workers has declined. Okay? Companies got efficient, and they're not going to hire these people back. Once you let the efficiency genie, that's it. You don't need a lot of these workers anymore to maintain or even increase production. So we had that boom. It's gone. So the Fed comes as we get the Fed minutes today, and the Fed minutes, and these are interesting because the Fed minutes, they're still seeing we have minutes and everything here, we highlighted and all that good stuff. The Fed minutes are calling Q1 transitory. We agree. We don't think that the economy is truly in contraction. We don't think the economy is truly a 1% positive recovery. We think it's in the 2s. That's probably all it is at this point. And the minutes indicate that only a few, and probably the most hawkish people, maybe Ms. Mester from the Cleveland Fed, the new Cleveland Fed, kind of hawkish, were of the opinion that we could tighten in June. Most of the officials well, later this year or 2016, excuse me. So while you can't say June is off the table, it could come in between now and then and warrant it. It probably will be off the table. Even the Fed minutes indicate that there's probably not going to be enough confirming data to warrant a June hike. So now, yeah, there's a meeting over the summer, end of July, beginning of August. I don't remember the exact dates. It flip-flops in the last couple days of July or the first couple days of August. There's a meeting there. It's not one of the more major meetings. They got the Jackson Hole conference right after that. So our guess is that the next time they'll seriously consider tightening would be September. But this September is probably a one and done. All right, we don't think they go a quarter and then a quarter and then they're 0 to a quarter now. They probably go to a quarter and they stop, and just to say they can do it, and they take a look around to see which way the wind blows. And the next tightening probably comes in the first quarter of 16, not because they're date dependent, because that's when they'll have enough data to confirm that it's the right time for another move, and then you see another quarter point, maybe even 3/8. Defined neutral as being the policy rate, the Fed funds rate, which fosters maximum job rate. So it's not adding. So it's adding as much job growth as you can get without generating too much inflation. Not the most job in pure terms, but the most relative to inflation. So it's like game theory. You know, you see what's the maximize a combination of the two. And that's what the Fed's trying to do. And there's opinion on the Fed now that rate is probably lower than the 4% or so it was before. No one on the Fed knows what it is. Why? Because even the Fed is conceding that the economy is structurally different. We don't know what it is either, but we're pretty confident that it is not as high as 4, and it might not be as high as 3%. Okay, so all of you who are worried about these sky-high interest rates and your bond portfolio will be worth next to nothing. No. And if you own actual bonds, you hold to maturity anyway. Just ladder a barbell and stay within your credit suitability, and you're fine. ETFs and bond funds, well, even FINRA's warning on those because you can get into some very crowded situations. You know, the ETF world is saying, yeah, but ETFs are liquid. Yes and no. One, the bonds inside might not be liquid, even though they're the largest deals. Most of these bond ETFs, are built to track an index, so they all have the same bonds or very similar bonds. So liquidity isn't just the size of the deal; it's the size of the deal versus how many people are in it. So if you have a bunch of people running to the door to sell those bonds at the same time, the buy side liquidity is not there to absorb it. And we said this, I think 2 weeks ago. There's a misconception that ETFs don't have to redeem holdings. There are authorized participants who can request the ETF company to create shares or redeem shares. And when those authorized participants come in to redeem shares, what often happens is the ETF company has to sell some of those bonds. So let's say you had a negative bond scenario, and I don't think it's coming. Well, let's say you did, and a bunch of these ETFs had to come in and redeem. They got redemption requests on bonds. Well, that's going to overwhelm the paltry liquidity we have on the street, and woof, you see the bonds go down, and that locks in realized losses there. Now, if you own your own bonds, who cares? They're down 10%. Great, I'll hold to maturity and get par. I don't care. But you can't do that with the ETF. You can't do that with at least not with most ETFs, and you can't do it with most bond funds. So FINRA was warning on that because these are not just paper unrealized. So keep that in mind. People have been waiting for liquidity to return to the market. There's a growing opinion out there that liquidity is not going to return to the market anytime soon. In the equity market, you don't have millennials participate. They're probably going right to balance strategies because they'll probably be in their 40s. So you don't have that demand on the equity side. retail participation in the equity market is a lot less than it was before. On the bond side, you have regulations and legislation that inhibits bond liquidity. So these really illiquid trading days you see, that might be the normal volume from now on, either demographically or on the legislative and regulatory front. Until that happens, these illiquid trading sessions might actually be normal. This might be liquid at this point. Over the summer, it could be less liquid. And the ECB mentioned that. Remember a few weeks ago, we said that the ECB was probably not going to take the straight and the rise in sovereign debt yields lying down. Well, the past several days, we have European officials advising, not warning, market participants that the ECB will be in the very near future buying bonds late this month through June, because they don't want to have to buy that when liquidity is even more sparse. When people in Europe are taking the summer holidays and people are vacationing here, market liquidity will really dry up then. So, we said this a couple weeks ago that, the crowded trade became uncrowded in European sovereigns. Now, equilibrium, there could be another leg down in long-term rates and another leg up in the strength in the price of the dollar versus foreign currencies. We're seeing that. We're seeing the dollar rally, albeit modestly. It was up to or down to versus the euro, still not quite a parity and not near its lows that we saw back in March, but it stopped selling off. So we think that whole selling off. We think the sell off in the dollar long dated treasuries for the most part might be over for now. Okay, now we're settling in, and we could be settling in for a long, boring, dreary summer. Okay. So that's where we think we are here. Now, one last thing we want to touch on, and this might run counter to what wholesalers are telling you or what UMA portfolio strategies are telling you, but we're finding more and more people in the bond market agreeing with us. And we heard it today with our friend at this major fixed income firm, Best Manager of Risk on the Street. We posed an idea, and because we've seen evidence already, that when interest rates rise and the yield available on low risk assets rise, many of the investors who reached for yield into junk and maybe even into equities will come back and go into higher quality fixed income to get similar yields they were getting in the junk or in equities, so they can get that at night. Well, lo and behold, our pals at this other firm agree with us as well. And we're hearing that from fixed income traders and strategists themselves, that this time you might not have the same response from how you did before. Typically, rates would rise because the economy is booming, inflation's running, that's good for junk. Then people would reach for yield on the confidence that the economy is improving. The yield reaches happen, and maybe the yield reach is overdone based on investor suitability. So you get a kind of reverse tide if and when low risk or riskless rates, in the case of treasuries, rise a bit. So they're of the same opinion. We're hearing it now, various corners of the fixed income world, that high yield could underperform, could actually see a tick up in defaults on a rising rate environment. Don't believe the story you hear from the equity geeks that go on the financial propaganda network and say, well, the only reason rates are going to rise is because the economy is doing much. Not necessarily. They spiked from 79 to 81. Economy wasn't doing much better. Now, we're not calling for stagflation, but don't think that that's the only reason why. We're not so concerned about rising rates. We're concerned about a modest rise in rates, especially on the floaters. You want rates to rise on the floaters? Wait till the companies can't afford to pay. And there's not enough revenues to meet it. Now, that's not our base case scenario. We don't think it gets better from this point. This might be the best it gets. Maybe it can maintain this situation, but we don't think it improves from here. Our message is, if you reached for yield, move up in quality and in our opinion, the best value in long-term rates and long end of the curve rather is in municipals. If you want to see charts, if you want to talk to us, if you want to pick our brains, call us during market hours, 570-424-1019. 888-888-1555. Our readership is growing. We have more people looking to use us to manage portfolios. I don't know if everybody at these various firms are happy because we're probably taking money from their in-house UMA models, but mutual funds are not for everyone, and especially if those who can actually think and reason. So, give us a call, send us an email. If you'd like a free trial of our newsletter, we're more than happy to give you that. My email is thomas.byrne, that's thomas.byrne at WSandM, that's Whiskey Sierra, the word and, M as in Mike.com. That's all we have for tonight. We think we covered everything we want. We discussed the yield curve, how it's probably going to flatten on a Titan. We discussed junk bonds that might have seen their best days. Lighter trading volumes might be the new normal. Lower interest rates, maybe not this low, but lower peaks than in the past might be the new normal. And the Fed minutes. The Fed is slowly coming around to the idea that it probably can't raise rates as much as it did before, and it's probably not doing anything anytime soon. And with that, have a great evening. Have a great holiday weekend. Please keep in your thoughts and your hearts the people whose sacrifice made this country great. The reason why we celebrate Memorial Day this weekend, there are thousands, tens of thousands of people who are not with us because they allow us to have this holiday. And with that, have a great night, and God bless you all. Goodbye.